Welcome to Looking at the Markets with David Modell. I found a really great, I think, video on YouTube by Kyle Stevens, so I want to give him credit. His video inspired me to make this one, and he made an Excel spreadsheet, and I just pretty much blew that up and put it up here. And I recommend that you check out his video, so I put a link to Kyle Stevens' video in the description of this video that you're watching right now, so you can click on that. And I'll also put a link to his YouTube channel, so I recommend you check that out. But the way I'm going to teach it is that it's not only about cryptos, this can also be applied to stocks, options, commodities, Forex, whatever it is that you trade. Okay, so can you start out trading with $1,000? Yes, you can. But my first tip to you is to be aware of the rules. Okay, especially in the United States, if you have a trading account with less than $25,000, then if you place 4 or more day trades, round trip trades within the same day, trading day, within a 5 consecutive trading day period, then you could be labeled by the Securities and Exchange Commission as a pattern day trader, and they can impose certain restrictions on your ability to trade. Now, this is only for margin accounts. This does not apply to cash accounts. If you want to learn more about the pattern day trader rule and ways to possibly get around it through certain modifications, I have a video on that, and I'll put a link to that video in the description of this video. You want to check that out for sure. You want to learn about the pattern day trader rule in the United States. So that's the first tip, is learn about that rule and the restrictions that can be imposed. All right, so another tip, just to get us started, if you have a small account with $1,000, is that you might want to consider, you don't have to, it's up to you what you want to do, you make your own decisions, but you might want to consider having a system where you cut your winners short and I'm sorry, I said it wrong, you cut your losers short. Cut your losers short and let your winners run. Okay, so for example, let's say you have a system where maybe you have a 1% stop loss. Okay, the most you can lose is 1% on any trade, and then your take profit is maybe 3% above where you bought it, or 2%, or whatever it is. All right, and so the amount that your max gain is greater than your max loss. Okay, that way, even if you're only right half the time and wrong half the time, you can still come out ahead over time, possibly. Okay, and so that's what this system is all about. All right, so let's say now Kyle Stevens, he introduced 3 possible scenarios. These are not the only possibilities for you. Okay, we're just keeping it simple with 3 possibilities if you have a $1,000 trading account. So one possibility is with every trade, let's say if you invested 100% of your account, all $1,000, okay, with every trade. And that sounds crazy. Normally you wouldn't invest 100% of your trading account in one trade, right? But if you have a really tight stop loss of 1%, then it's not as risky, is it? It's not so risky after all, okay? Yes, you're throwing 100% of your investing account into a single trade, but you've got a tight stop loss of 1%. Now, stop losses are not perfect. There are gap downs, okay? And so you can lose more than 1%. There's slippage, all right? There are gap downs that can be pretty vicious, especially if there's an earnings report or bad news comes up in the middle of the day, or if you hold overnight, the stock or whatever it is can gap down more than 1%, that's for sure. So don't count on this being a perfect, system. Don't count on stop losses being perfect like they are in these examples. But we're going to pretend they're perfect for the sake of example, even if that's not true in real life. All right, so let's say you set your stop loss so your max loss can only be 1% on every trade. So then putting 100% of your capital into each trade may not be so crazy after all, may not be so risky. And also if you have a take profit where you let your winners run up to 2, 3, 4, 5% per trade, maybe it's not so crazy after all. Okay, but again, you have to make the decision on what you're going to do. All right, so let's say you start with $1,000 and you invest 100% of it, all 1,000 in, with a 1% stop loss. And so here's some trades, and let's say on trade number 1, you get lucky. Yeah, it's just a really good trade, and you take profits after you get a 5% gain, right? So now your $1,000 is now $1,050 in your trading account. But then the next trade, you don't do so well. You're unlucky or whatever, okay, and you lose 1%. It's not so bad because you're letting your winners run, cutting your losers short, fine. And guess what? After 2 trades, a winner and a loser, you're still ahead, aren't you? Because you let your winners run and you cut your losers short. And so you're still up altogether. You have $1,039.50. That's higher than what you started with. And the next trade, you do well, you gain 4%, so now you're up to $1,081.08, so on and so forth. And let's say you have a 60% win rate, 60%, okay? You lose 40% of the time, you win 60% of the time with this system. Because remember, you have a tight stop loss, so you're going to lose a lot of the time. You might expect to lose 40% of the time, okay? So it's not a great, 60% is not a great winning ratio, but with such a tight stop loss, that's likely to happen, all right? Because the price doesn't have to go down very far for you to lose the trade and get stopped out, all right? But still, with a good trading system, using whatever it is, moving average crossovers, or MACD or stochastics, and I have videos on all those, by the way. You can check through my past videos if you want to. If you have a pretty good trading system, then you should be able to get, even with a tight stop loss, you should be able to get 60% gain. That's pretty reasonable. Or 60% win rate, I should say. So you could possibly, after 10 trades, with a good system, turn $1,000 into $1,200. 20% gain in 10 trades. Not too bad at all, actually. All right, so that's scenario number 1. Scenario number 2 is investing only half, 50% of your trading account. So like $500 out of your 1,000. Investing 50% of your account with every trade. Okay, so now you can put your stop loss lower. All right, you can put your stop loss, instead of 1% below where you bought it, you can make it 2% below where you bought it, because you're only investing half as much of your money, right? And what's good about this system is that, first of all, you can put your stop loss lower, and so your win rate is probably going to be higher. If you look through these, notice that, yeah, the win rate here in this scenario is 70%, whereas the win rate with the tighter stop loss is only 60%. All right, so you could possibly, or probably I should say, win a greater number of times. Now, on the other hand, put it this way. If you only invest 50% of your account, there's another advantage, which is that now all of your money is not tied up. With this first scenario, when you invest 100% of your account into one trade and you see other trades you'd like to take, well, too bad, so sad. Your entire trading account is tied up in this one trade. Whereas if you only invest 50% of your capital in any trade, and then you see another trade you want to take, you can take it if you didn't use up that other, if the other 50% of your capital is just cash, just sitting there, all right? And again, you could have a higher winning rate because your stop loss is lower. So this seems preferable to this. This seems like a better idea because of those two big advantages. All right. So yeah, every time you lose 2% instead of 1%, but it's only 50% of your account. So it kind of ends up the same, doesn't it? Really, in a way. Okay. So let's say you start out with you trade 50%, which is $500 of your 1,000. Okay, and let's say you do pretty well that first trade. You take profits at 3%. Okay, so now you've got $515. Great. The next trade you don't do so well. You got stopped out with a 2%. 2% below where you bought it, but you're still ahead because you're letting your winners run, cutting your losers short. Okay, you've got a favorable risk to reward ratio going on every single time, so you're still up $504.07 from the 500 you were placing into the trade originally. And you go through it. Let's say you win 7 out of 10 times because you have a good system using, moving average crossovers or whatever. And you come out ahead. You can possibly turn $500 into $584, let's say. That's pretty good, right? Here's another possibility. Investing only 25% of your $1,000 of your investable capital in your trading account with each trade. And so now you can place your stop loss even lower. You can make it 4% below where you bought it. And it's about the same risk as these other two scenarios, right? So you're going to win an even greater, let's say 80% of your trades, because your stop loss is nice and low. So now even if you buy the stock or whatever it is and it goes down 1, 2, 3%, but then a lot of times you get head fakes in the markets. You'll buy a stock and it swings low, but then it comes right back up. That was a head fake, right? Happens all the time. And so you don't get stopped out so much. because you've got a lower stop loss. All right, and yeah, so you have a higher win rate, and you're only tying up 25% of your capital. And so if you see maybe 3 other trades you want to take, you can, if the rest is sitting in cash. All right, how would that work out? Well, let's say you win your first trade, you know, 3% profit. You win the next one, you do really well, but then, yeah, okay, you take a 4% loss, you know, on the next one. Okay, but you're still ahead, aren't you? All right, and then you go through it. If you have a good system and a nice low stop loss, but you're only investing 25% of your account, you come out ahead. You could possibly turn, let's say in this scenario, turn $250 into $291. Hey, not too bad, right? That's quite respectable after only 10 trades. Not bad at all. If you're a day trader, those 10 trades might happen in one day. All right. Now, you got to be aware of commissions if you're day trading like this and you're using small amounts of capital. If you're only investing $250 per trade, you know, I don't want to say only. I mean, that's a lot of money to a lot of people, but then you probably want to have a low-cost broker for sure, because, you know, you don't want to have to eat up $10 per trade every single time with one of the more expensive brokers if you're only putting $250 in the trade. All right, you don't want a large percentage of your profits to be eaten up by high commission costs. So find yourself a low-cost broker for sure, or even a free broker. All right, so what do I recommend out of these 3 scenarios, which are not the only possibilities at all? You have to decide what you're going to do, make your own decisions. I kind of like this one the best because I don't like tying up a lot of my capital. All right, I wouldn't want to tie up the entire $1,000 because as soon as you see one opportunity, another one tends to come along, doesn't it? Okay, and there are a few things more frustrating in trading than having all of your capital tied up and you see a really great opportunity and you can't take it. I also like this win rate. Okay, I like the 70% win rate, even though mathematically it kind of ends up the same, really, but it's just psychologically winning 7 out of 10 times feels better, and it's more motivating than winning only 8 out of 10 times. Is psychologically more comforting and more encouraging and more motivating than only winning 6 out of 10 times, let's say. All right. It just makes the job of trading, or the business of trading, and I hope you're treating it like a business. You should be if you're not. It just makes it more enjoyable, and you just feel better about your trading. Okay, you're less scared when you're trading, when you can be confident that you're going to win more, and it keeps you in the trade longer. You're not getting stopped out so much because you have a lower stop loss there. So I like this one the best for me. Okay, so consider maybe this type of method. You don't have to use these numbers, and it's not always going to work out like this. All right, you're going to have bad days. You might have days when you lose 100% of the time. All right, it's going to happen. So be ready for that. So thanks again to Kyle Stevens. I appreciate it. Please check out his channel and his videos, and I'll put links in the description of this video. And I do coach people, so if you like some coaching, you can email me at davidmodell@gmail.com. And if you like this video, and if you like the fact that I'm going out and hunting down cool ideas and cool strategies that I can share with you, then please give this video a thumbs up on YouTube and subscribe to my channel if you haven't done it already, and hit that notification bell and leave a comment. What do you think of this? Which of these would you probably do? Would you just go for it and put in all $1,000 with every trade, but keep that tight stop loss? That's a possibility too. All right. Or would you do the one that I would probably lean toward, which is putting less capital in per trade, leaving the rest in cash for other opportunities, leaving that dry powder, as they say, and then having a lowered stop loss? Just let me know what you think. All right. Thanks a lot. I appreciate it. I'll talk to you guys again soon.